Hello, Professor. Let's start with the first question. Explanation of bond will trade higher figure in the market. So, bond the market price of a will rise due to its delayed maturity. Since long-term or term bond are more likely to appreciate, they cost more. Investors prefer to pay more for bonds with longer maturities. The expanded maturity period gives investor a better chance to capital gain in interest rate fall, justifying this option. Since bond will be held to maturity coupon and principal payment will remain constant. So, if interest economy grow up, so in the event of an increase the interest rate within the economy, mm, both of bond A and B will see decline in their market value. This is due to the fact that investor will inclined to purchase bond when the interest rate in the economy exists in the coupon rate of the bond. Therefore, investor will remain a reduced price in order to compensate for diminished yield the anticipate from the bond. So, which bond would see a greater percentage price fluctuation in response to an increase in interest rate? If interest rate climb, the price of bond B will experience a more significant percentage change. This phenomenon occurs because changes in interest rate have a more significant effect on bond that have a shorter period. A rise in interest rate will cause a greater decrease in the value of short-term bond relative to a long-term bond. So let's move to the numerical example part. So assume both bond have $1,000 principal and 5% interest, and bond A has 30 years before maturity, while bond B has 5 years. Says so the economy has 5% interest rate. Bond valuation method calculate each bond's future cash flow current value. Bond A has a 30-year present value. So present value equal to coupon plus interest rate, we all know. So this computation predicts 30-year cash flow present value. Divide each coupon payment by 1 and the interest rate to calculate cash flow. Divide per value, get ultimate cash flow. The user typed is 30. Bond B's 5-year present value is computed using the formula present value equal to coupon payment into 1 plus interest rate. Cumulative value of a serious financial transaction is decreased by the interest rate and increased to the power of their time period. So power 5 exploitation, suppose bond A is 800 and bond B is $900. So we will research value if economy's interest rate hits 6%. The present value of bond can be calculated using the formula of present value equal to coupon rate, interest rate plus coupon payment plus interest rate per value. So bond has a $750 current value, but bond V has $850 revised present value. So according to those calculation, bond A had more price valuability after interest rate increase than bond V. So let's study a numerical example to clarify this. So a government bond or bond with high credit ratio rating are good investor investigates for bond investor who expect an economic downturn. So reduced credit rating promotion promotes recreation related compared defaults. By choosing shorter time, bond investor can strategically switch to bond with higher returns interest rate rise. Investor risk tolerance and financial goal would influence by investor plan. So let's move to the last question. So as a bond investor, if you expect a slowdown in economy over the next 12 months, what would be your investment strategy? So I'm gonna share my investment strategy. So I would spend differently as a bond investor who expect the economy to fall, safeguard my wealth and make my money. So what could be done? So increase your high grade bond investors. When the economy is shaky and investors seek safer investment, a large portion of my investment portfolio may need it to be shifted to government or investment grade company bonds. However, those are safer and less prone to fail. So treasure extension. If economy interest rate fall, I may extend my bond holdings. Longer term bonds are more interest rate sensitive. Lower rates boost the value of bond with higher yields. Implement sector diversification. So risk management requires a broad investment portfolio across industries. Separating my bond asset across industries reduce concentrations risk. For instance, a portfolio of government, municipal, and business bond may provide a balanced distribution. Distribution. So check out the defensive sector. Energy and energy and consumer staple are defensive since they are less affected by economic downturns. So investing in bond from those comparison may help to economic tanks. So next step will be check credit quality. So monitor portfolio bond credit worthiness. Business may struggle to pay debit during recession. Focus on investment grade bond securities with higher rating to reduce default risk. Maintain a large cash reserve. So bad economies can cause market volatility. So investment that can sold quickly allow to take advantage of opportunities and adapt to make developments. So naturally, this is a basic outline. Investor risk tolerant, financial goals, and economic STEM details would be determined to plan getting concept. So thank you, Professor.